let's now go into the computation of financial ratio. Ratios are computed using financial data from a company's financial statement. Without a financial statement from a company, ratios can never be computed. The financial statement, such as the income statement, of course, we can get a whole lot of figures and facts out there. The balance sheet, the cash flow management. So let me now talk about some common financial ratios and their formulas. The first one is liquidity ratio. Liquidity ratio, they are the category of financial ratios that assess a company's ability to meet its short-term financial obligations and convert its assets into cash quickly without significant loss in value. And these ratios provide insight into a company's liquidity and its capacity to cover its immediate financial needs. Immediate financial needs such as paying off current liabilities and assessing unexpected expenses. And this is categorized into two. The first one is current ratio. The current ratio is a financial metric that are being used to assess a company's short-term liquidity and its ability to cover its short-term liabilities or their obligations. With its short-term assets, it measures the company's capacity to meet its financial obligations that are due within a year, 12 months. These are typically referred to as the current liabilities. Using assets that are expected to be converted into cash or used up within the same time frame. The same time frame that is known as in the current asset. And the formula for calculating this is given as the current asset divided by current liabilities. Another second one which it comprises is a quick ratio or acid test ratio. Quick ratio, it is a financial metric that are being used to assess a company's short-term liquidity and its ability to meet immediate or near-term financial obligations without relying on sale of inventory. Quick ratio, it is a more stringent measure of liquidity compared to the current ratio because it excludes inventory from current assets. And the quick ratio in this instance is particularly useful in situations where a company's inventory may not be easily convertible into cash in the short term, such as when there are uncertainties about selling the inventory quickly or if the inventory has a low market value. And the formula for it is current assets minus the inventory divided by the current liabilities of the business. The second ratio is the profitability ratio. And of course, I'm going to give the formula for profitability ratio. But let me talk about the meaning of profitability ratio. Profitability ratios are financial metrics that assess a company's ability to generate profits relative to its revenue, relative to its assets, relative to its equity, or relative to their other financial measures. And these ratios provide valuable insight into the company's overall profitability and its effectiveness in managing its resources to produce earnings. Profitability ratios in this instance are essential for evaluating a company's financial performance and attractiveness to investors. It is often divided into 4 categories. The category 1 is the net profit margin. The net profit margin in this instance is a profitability ratio that measures the percentage of profit a company earns from its total revenue after deducting the operating expenses, the interest, the taxes, and other costs. It is a key financial metric that are used to assess how efficiently a company generates profit from its operations and is often considered one of the most critical profitability indicators. And the formula for it is just to calculate Net profit divided by total revenue multiplied by 100%. The second category is the gross profit margin. The gross profit margin is a financial profitability ratio that measures the percentage of profit a company earns from its total revenue after deducting the cost of goods sold. The acronym for cost of goods sold is COGS. The COGS assesses how efficiently a company manages its production cost and the profitability of its core business operations, thereby excluding other operating expenses such as selling, general and administrative expenses or interest and other taxes. So if you want to apply formula for this, formula for it is quite simple, just as the other one. The formula is just to have your gross profit, you divide it by the total revenue, then you multiply by 100%. Third category is return on assets, ROA. This is very important and often common, right? ROA is a financial metric that measures a company's profitability and efficiency in generating earnings from its total assets. Because ROA provides insight into how efficiently or effectively a company utilizes its assets to generate profit. It is a critical indicator of a company's financial performance and management ability to deploy assets for the benefit of shareholders. And also, I'm going to give formula for it. The formula for it is given as a net profit divided by the total assets of a company multiplied by 100%. So let me now go to the fourth point on what I was listing. The fourth one is the return on equity, ROE. The formula for ROE is net profit divided by shareholders' equity multiplied by 100%.